Right now, across India's largest megacities, a massive logistical experiment is playing out in the streets. The quick commerce sector has turned urban retail into a hyperkinetic race against a 10-minute clock. At the center of that race is Blinkit, led by founder Albinder Dinsa. By early 2026, Blinkit had secured a commanding 45 to 50% share of this highly contested market. The sheer throughput of the operation is staggering. In the final quarter of fiscal year 2026 alone, their network processed roughly 274 million individual orders. Tracking Blinkit's implied valuation over time, in March 2023, analysts priced it at $2 billion. By April 2024, it surged to $13 billion, making it more valuable than Zomato's core business. Yet Blinkit posted an EBITDA margin of just 0.3%. To translate that into raw capital, out of 14,386 crore rupees in net order value, they generated a barely visible 37 crore in adjusted earnings. A positive EBITDA figure does prove the business is no longer bleeding cash on its day-to-day operations, but it is mathematically miles away from being a high-return venture. Blinkit's $13 billion valuation is not a reward for trailing financial performance. It is a highly leveraged bet on the underlying mathematics of urban density. The modern version of Blinkit was born from a structural flaw in its predecessor. Originally known as Grofers, the company operated a third-party marketplace, pulling inventory from existing neighborhood stores. That reliance on external partners placed a hard ceiling on delivery speed and reliability. This diagram illustrates the 2021 restructuring. Left, the unpredictable third-party web. Right, the pivot to a direct dark store network with a strict 10-minute radius. But achieving this control required massive upfront capital for real estate, cold chain tech, and inventory. Under normal venture capital conditions, sustaining that cash burn would have severely diluted the equity of a distressed startup. The 2022 Zomato acquisition functioned as a strategic capital rescue. The all-stock deal provided Blinkit the runway to scale without external dilution. Zomato's profitable, cash-generative food delivery business provided a fortified balance sheet. This stability insulated Blinkit from the funding droughts freezing private markets at the time. This waterfall chart demonstrates the scale of that internal funding. By fiscal year 2026, Zomato injected approximately 1,700 crore rupees of free cash flow into Blinkit purely for capital expenditure, roughly 450 crore a quarter, completely dwarfing that tiny 37 crore EBITDA output. Armed with that capital, Blinkit aggressively expanded its physical footprint. They rolled out over 2,243 dark stores, overwhelming undercapitalized rivals through sheer infrastructure density. By abandoning the asset-light approach, Blinkit gained absolute control over its unit economics. But that execution was entirely dependent on Zomato's willingness to subsidize the expensive, multi-year infrastructure build-out. That heavy capital expenditure successfully bought top-line momentum, driving a 95% year-over-year surge in net order value. E-commerce revenue growth relies on three multiplicative variables: dark stores, users, and average order value. In 2026, dark stores expanded by 73% and users exploded by 98%, but average order value remained completely flat at exactly 525 rupees. The static basket size reflects a specific consumer psychology. Blinkit has mastered the habitual top-up, like a forgotten ingredient or late-night snack, but it fails to capture the large, high-value weekly grocery run. That stagnation is dangerous for a business operating on a 0.3% margin. Fixed logistics consume the exact same baseline cost, whether a rider carries a pack of gum or $50 of produce. To counter this, management is aggressively pivoting into higher-margin verticals. They are rolling out gourmet grocery lines and expanding into consumer electronics, intentionally trying to inflate the baseline basket value. Because organic spending per trip is currently static, Blinkit's impressive revenue growth is effectively a geographic land grab, driven by capturing more neighborhoods rather than evolving consumer spending power, which forces a glaring macroeconomic question. If the 10-minute delivery model is structurally sound, why did it trigger a mass extinction event in Western markets? During the 2024 venture funding dry-up, European pioneers of this exact model, like Gorillas and Getir, faced spectacular collapses and distress sales. Their failure was a geographic mismatch involving incumbent retail. Startups in the West competed against highly efficient, dense supermarket chains that already offered extreme convenience. Contrast that with India's incumbent retail landscape. Quick commerce here went up against a highly fragmented, variable trust network of neighborhood kirama stores. This table contrasts the primary mathematical constraint of the business, the ratio of delivery labor cost to the overall order value. In Europe, minimum wage laws and strict gig worker regulations meant that human labor consumed the vast majority of the gross margin on every small basket. India's gig economy labor pool changes the mathematical outcome. The lower per-delivery wage allows Blinkit to easily absorb the fixed logistics cost of a 525 rupee order. Combine inexpensive labor with extreme urban density, and utilization skyrockets. A single Indian dark store reaches exponentially more households than a comparable store in Europe. This density is exactly why mature markets like Delhi NCR are finally proving the model works, consistently achieving 5 to 6% contribution margins at the individual store level. Quick commerce functions as a highly specific geographic arbitrage, dependent on the intersection of local labor costs and extreme urban density. But contribution margin only tells half the story. It proves individual dark stores generate enough gross profit to cover their own rent and delivery staff. It does not account for corporate overhead, technology costs, or central marketing. Management's ultimate corporate goal is to bridge that gap, officially targeting a 4 to 5% adjusted EBITDA margin across the entire business at scale. To reach that scale, they have outlined an aggressive roadmap, expanding the network from 2,243 locations to a staggering 3,000 dark stores by March 2027. This expansion introduces a severe structural risk. Blinkit is rapidly running out of premium, high-density metro territory, forcing the network to push outward into Tier 2 and Tier 3 cities. This sensitivity analysis projects what happens next. Smaller cities lack the extreme population density and per capita online spending of the major hubs. If those Tier 2 stores fail to match the 5% baseline set by Delhi, the corporate EBITDA margin risks crashing below zero. That geographic risk is compounded by secondary threats. Looming regulations around gig worker social security, alongside India's complex foreign investment rules on inventory ownership, threaten to drive up baseline operating costs. Meanwhile, independent rival Zepto is actively pursuing a public listing despite massive internal losses. An IPO could arm them with the capital to reignite a margin-crushing discount war to secure market share. All of this circles back to that 0.3% margin. There is absolutely no financial cushion to absorb a price war, a labor cost spike, or a failed Tier 2 expansion without plunging the business back into the red. Blinkit's sheer market dominance is an undeniable operational triumph. But its $13 billion valuation doesn't just reflect past success. It hinges entirely on the precarious, unproven assumption that the hyper-local density math of New Delhi can be systematically copy-pasted across a subcontinent.